Hello, ladies and gentlemen, and welcome to our interview with Kyrill Asatur. Kyrill is a co-founder and CEO at Centerfin, which provides an institutional quality wealth management solution to everyone by utilizing an investment approach similar to other long-term investors, such as endowments and family offices. And Kyrill has 20 years in hedge fund and alternative investment industry, including Golub Capital, Riva Rich Capital Management, and Goldman Sachs. Kyrill, thank you for coming to our interview today.
Boris, thank you so much for having me on.
Absolutely, it's my pleasure too. Kyrill, could you tell us a short story about your career path, what brought you to where you are at now, and maybe what you are up to these days at Centerfin?
Absolutely, glad to. So I was fortunate enough to start my career at Goldman Sachs a little over 20 years ago. And I spent most of my time at Goldman Sachs in the prime brokerage business, which is the business that effectively deals with the hedge fund industry. And so this was early 2000s. The hedge fund industry was just becoming institutionalized, as they say, and growing pretty quickly. And it seemed like all of the smart Wall Street minds were starting hedge funds. And so I decided to really try to focus my career in that industry. 8 years in, I was hired by a client of mine, a hedge fund that was founded by two ex-Goldman Sachs distressed investors. And they hired me in 2009, right kind of in the middle of the financial crisis. And I spent about 5 years there. And then I got recruited, as you mentioned, to Golub Capital, which is a big middle market lending firm that had a credit hedge fund business that they wanted me to focus on. And so I spent a little time there before starting my own advisory practice focused on alternatives. And the idea there was really, I felt like I'd been in the business long enough where I knew a lot about a lot of different strategies. And I knew a lot of, I had a pretty good network of investors. And the idea was to try and diversify my risk, so to speak, of not working with one manager, but working with multiple managers. So I started doing that about 6 years ago. And then about 2 years ago, I started what is now Centerfin. And the idea for Centerfin really came to me organically. So I've been interacting with large, sophisticated institutional investors my whole career. So, as you mentioned, endowments, foundations, family offices, pension funds, insurance companies. And at the same time, in my personal life, friends and family would come to me time and time again, asking me for advice on what to do with their money, whether, they had some savings, they had inheritance, they had, their retirement accounts. And I honestly did not have a good solution for them because what I saw in the options that were available to them were basically the same things, were basically some variation of a 60-40 portfolio, which is effectively, 60% equities, 40% bonds. And I had, had a different view because I'd been interacting with, large institutional investors and working in the alternative space that there's a better way to do it, especially if you have a longer term mindset. And so the idea was, why can't we replicate the way endowments and sophisticated, family offices and pension funds invest money for the long term, but do it so that we can open it up to a broader audience. And so that's what we set about to do about 2 years ago. We launched in beta at the beginning of this year. We opened it up more broadly a couple of quarters ago, and it's going really well.
Okay, fantastic. So I believe that we will have a very thoughtful conversation on capital markets in general and the wealth management industry in particular, maybe with some actionable tips if it's okay for you. And so, Kyrill, can you tell us what problem does your solution solve, or why there was a need for your solution? For example, there are a lot of trading tools like Robinhood, maybe they kind of for retail investors. So is it overhyped industry right now? Can you share your thoughts about it?
Yeah, so I would say it's what we're doing is different than Robinhood. Robinhood is what's considered self-directed brokerage. So effectively, you open up an account, you move some money over, and then you trade stocks, and you pick and choose your stocks, and hopefully you make money over time. My experience, my personal experience, I started kind of following Wall Street while still in college in the late 90s. And if you recall, that was the first internet bubble that happened in the late 90s. And that was also when E-Trade became a thing. And E-Trade, I would parallel to Robinhood, but 20 years ago. And I was one of those, young college kids that I opened up, I borrowed some money from my dad. I opened up an E-Trade account and I, put my, the money my father lent me into the account. And, within a couple of months, I, doubled or tripled it, I forget. And, I thought it was genius. Like a lot of, I think people thought, in the 2020s, 2021s, kind of, as we had this other boom, led by different things. And then, the internet bubble burst, in 2000, 2001. I ended up losing almost all of that money. And so I learned a very hard lesson, luckily early on. And
yeah,
so
exactly.
Yeah, exactly. And so, you have to kind of learn these lessons yourself. And so when I was seeing what was going on with Robinhood and some of the crypto stuff that was going on in 2020, 2021, I was just seeing a repeat of history. Not exactly, but as they say, history rhymes, doesn't exactly repeat. And so the solution that we built is one where we actually manage the client portfolios for our clients. And the reason we think that's important is because again, there are other options. There are financial advisors, there are robo advisors, but again, the vast majority of them, 99% of them, when it comes to everyday individuals, whether you got $50,000 or $1 million even of investable assets, you're going to get some version of our cookie cutter 60/40 portfolio. It might have tweaks here and there, but that's what it's going to be. And then you're going to get charged a lot for it. And again, shaped by our experience, we felt like that wasn't enough. And so what we decided to do was build something where it wasn't just stocks and bonds. It was stocks, bonds, commodities, alternatives. And we felt like, especially in this environment, it's really, really important. And, as you see, we talked, you mentioned capital markets a little bit. If you look at what's happening today for a 60/40 portfolio, it's had its worst start to the year in its history. I mean, since they started tracking it. And the reason being is something that we argued late last year as we were just getting going, was that the fixed income portion or the bond portion of your portfolio, which is historically designed to be the quote unquote safe portion of your portfolio, was actually highly risky going into 2022.
20% or something, yeah.
Yeah, and the reason being is quite frankly because inflation, at least in our view, we thought was going to be more than transitory, and the Federal Reserve is going to have to raise interest rates. When interest rates go up, the value of fixed income securities go down. And so our view is that it'd be challenging if you were to just go into 2022 with a portfolio of stocks and bonds, especially because those bonds, which when stocks go down are supposed to go up, are acting in the same way, which doesn't really happen and hasn't really happened in recent history. And so, so that's a little bit of kind of our thought process and what shapes our perspective.
So you add to the mix commodities and alternative like metal, exact exposure to precious metal or other commodities like indexes, commodities indexes, or what?
Yeah, so it's a combination of precious and base metals. It's also some energy equities. We actually came into this year underweight energy. We fixed that in the first quarter. The reason being is that it became pretty evident that not due to inflation, but due to fundamental supply demand issues, that the world was just short energy, and that continues to be the case today, even though the oil price has spiked because of the Ukraine war and then come right back down to where it was before the Ukraine war. It doesn't really change the bigger picture. In our view, there's a fundamental supply demand mismatch in most commodities, and energy being a big one. What we're seeing today, as I'm sure you're aware, we're seeing these headlines out of Europe where they're worried about power prices for this winter season. People in Germany are stocking up on wood to heat their homes using wood, which is going back a couple of generations in time. This is all a result of really what were in hindsight flawed energy policies.
Yeah,
And we're
policy.
seeing it in the U.S. too. I mean, we're seeing it in California right now, where the governor of California is on TV just this week, pleading with people to not use energy during certain hours of the day. I mean, it's not how things should work in the developed world, but that's what we're seeing right now.
Mhm. So, what is your current assessment of global financial markets? Maybe we can start with a general question.
Yeah, it's a really tough. It's a really tough environment. It's probably the toughest environment in the last several decades, at least, if not longer than that. And the reason being is because we've never been, or we haven't been in this type of situation in a very long time, right? So we have inflation that has been persistent. It's showing signs of coming down. Although in Europe and other places, it's still very elevated. If you look at the UK, we're still in the double digits, which is crazy. Um, and um, and the global central bank policies have to address that, right? Because inflation affects the bottom half of the population the worst, right? It's people that cannot afford to live beyond paycheck to paycheck, that need to put gas in their cars and heat their homes and buy food to put on the table, that are affected the most, right? So central banks need to act to bring the prices of those things down, and that's what they've been doing. And that's contrary to the policy that we've seen since the global financial crisis, which has been a very, very easy monetary policy. As we've
Yeah.
had QE, we've had negative interest rates, across Europe, and that's a very different environment. And so our view is that COVID, this has been talked about a lot, but COVID accelerated a lot of trends that were already in place before COVID kind of hit us. So simply put, e-commerce and work from home and Zoom, what we're doing right now, these were all things that were already happening and were growing and accelerating. COVID just accelerated that. On top of that, COVID accelerated effectively what the Federal Reserve and the global central banks needed to do, and when they responded to COVID by extraordinary easing, they were going to have to go the other way. And now it's almost like we jumped the shark, where the central banks don't have a choice but to continue to tighten. And again, we have not been in this type of environment since the global financial crisis. And the big difference between today and the last 12 years or so is that since the global financial crisis, and really over the last 2 decades, we've had globalization, right? So we've had developed countries in the West offshoring for cheap labor in the East. We've had the import by the West of cheap energy from the East, primarily Russia, obviously, and that's all changing as we speak, right? We have, we always, and this started before COVID, but we almost have a deglobalization movement right now, where the West and the East are separating. So it's looking more like the '80s than it looks like in the 2000s, right? And why that's important is because globalization in itself is disinflationary, right? So the Federal Reserve and global central banks can print a lot of money, but you have the opposite effect of cheap labor coming out of China, cheap energy coming out of Russia, and that's deflationary. So it kind of offsets. And so that's why you didn't see inflation out of control, even though the Fed was quote unquote printing money, and the ECB was printing money, and all the central banks were printing money. And so that's why you had this period in post 2008, post the financial crisis, where the Federal Reserve and global central banks were printing money, so to speak, but inflation was fairly tame, sub 2%. And all you heard about the central bankers talking for the last 12 years was how inflation was not high enough. Inflation was not high enough. So, fast forward to today, well, then now inflation is too high, all right? And now they're talking about getting inflation back down to 2%. And the problem is that, that's obviously restrictive to financial conditions, and it's going to potentially cause a recession. Most likely will cause a recession, certainly in Europe and most likely in the US. And the response to a recession historically has been easing. The problem that we think about, and I don't think anybody knows the answer to this, but it's something to be cognizant of, is that the regular policy response to a recession, right? So if unemployment starts to rise, the Federal Reserve starts to ease. The problem is we don't have the disinflationary force that we had before. So we don't have globalization anymore. And so the worry that we have and that we think about is what happens when the economy does start to slow down and potentially shrink, and we go into a recession and unemployment starts to rise. And the Federal Reserve acts like they're supposed to act, which is by easing monetary policy and lowering interest rates. What happens to inflation then? How does inflation react? Because
stagflation or something.
Yeah, and so it's a very like I said, from a capital markets perspective, global markets perspective, it's a very challenging environment because we have not seen this. We've not quite seen this exact thing in I think ever, but we haven't seen elements of this since the 1970s and 1980s.
Yeah. And that time there was a Walker guy that put inflation, what is it, the exchange rate to the 20% or something that removed the inflation.
Yeah. Paul Volcker famously, his legacy was he was able to break inflation by being really aggressive and hiking interest rates and throwing the economy into a recession, but dealing with that pain. You're seeing some of this language out of Jerome Powell, the current chair of the Fed, where he has said famously at Jackson Hole, prepare for pain. He's talking about hardship, right? He's talking about potential recession, unemployment going up, and I think again, I don't think anybody but Jerome Powell knows the answer to this. But I think reading the tea leaves and talking, reading people that talk to the Fed and that are close to the Fed, it seems like he'd rather be Paul Volcker than Arthur Burns, who preceded Paul Volcker and was in charge when, every time there was a blip, every time there was, a blip in the economic environment, he reversed course and eased, and inflation was very, very persistent during the 1970s because of that.
Yeah, but probably today, if you go to increase rates substantially, the debt level will not allow you because United States will not be able to support the level of debt compared to what was in 70s, right?
Yeah, that's the other thing that we talk about and think about is, this is we were literally just talking about it this week, which is, we have not seen interest rates at these levels since. So presumably we're going to 4% on the federal funds rate by the end of the year, right? That's kind of what the market's pricing in. Although the two-year Treasury is still at 3.5, which would tell you that we're the market's not pricing it in, but the predictive market of Fed fund hikes tells you that we're going to go to 4%. We haven't been 4% since 2006, 2007, which was right before the financial crisis. The debt to GDP ratio, as you say, was much lower back then because we've taken on a lot of debt, and a lot of that debt matures on a regular basis and needs to get refinanced. And so, as the U.S. government looks to refinance its debt, the interest rate on that debt is going to be much higher than it has been in the recent past. And is that sustainable? And we think about that a lot as well, because the fiscal situation not great, and interest rates are going higher. And is that even sustainable? And what's going to break? And we haven't even talked about the dollar, but the dollar is extremely strong versus almost all currencies, and that has potential very negative ramifications abroad, but also for the U.S. longer term. So it's like I said, it's a precarious environment. It's not one where there's any obvious paths that we see, but there's a lot of storm clouds, so to speak, on the horizon. There's a lot of potential issues that I think one needs to be aware of as they're thinking about how they're managing their wealth, because we see a scenario, and this is simplistic in a way, but I talk to people all the time about this. A lot of people say, just buy the Vanguard, S&P 500 or the Vanguard Global Equity Index Fund, and just average in, and it'll be fine. Well, I mean, that's great, except that if you look at the and that worked for the last decade or so. But if you look at the returns, if you were to do that in the 2000s, from 2000 to 2010, a lot of people don't know that if you just owned equities from 2000 to 2010, you actually you lost a little bit of money over that period of time. So I often ask people, how would you feel if, a decade after today, based on what you're doing, you made no money. And, with inflation, you probably lost money. And people are surprised that that's actually happened in recent past. That's only, been in the last 20 years.
Yeah, I know. So I also started, I think, my investment kind of small account, and I started actually, what was it, 2000, when it was, I had a lump sum and I put it in the internet market, and I said, people told me, just do it, what you believe in, and because I work in the IT industry, so I had to do this, and forget about it. In 20 years, come back, and I forgot about it, and when I came back in 5 years, it was, I think, sort of. But then I waited, and this account actually rose after 2010. So actually, this
Yeah,
is how.
yeah, exactly. It was dead money for 10 years. It's
10
insane.
minutes, but I was younger. I didn't need the money. But what would be your kind of advice for people like not young, that they need the money in 5 years or something? What the decision for individual investors should be?
Yeah, and I should disclaim this, that we
Yeah,
are a registered
of
investment
course,
advisor, so
of
nothing
course.
nothing I talk about is investment advice. But I will say that what we are thinking about, and what we're talking to our clients about, and we're talking about internally, is having hard asset and commodity exposure as part of your allocation of your assets. We think is going to be important over the next decade. So that's one thing that we think about, and simplistically, that that could just mean value equities, right? So that includes a lot of different things, but the opposite of what was working for the prior decade, which was mostly growth, right? So mostly growth equities. The other thing that we think about a lot, and this is really consistent with our backgrounds, but less correlated strategies. And so this is where the alternatives piece of it comes in. So we are big fans of certain things like distressed debt, which is, especially going into a recession, is a very interesting strategy to deploy. And this is where both my CIO, myself, and our CFO, we have a lot of experience in dealing with managers that manage those kinds of strategies. And so it's something that we're exploring right now as we speak, and we think could be very, very interesting as part of the broad asset allocation. But I will say, to your point about internet stocks in 2000, crypto, as I'm sure, has been a topic of conversation for you and in your inner circle and in your community. My view on crypto has been the same, and it hasn't changed in 4 or 5 years, which is, it's really interesting. There's something there. It's highly risky. It's still early. You have to size it accordingly. So to talk about risk management, one of the things I learned working for the hedge funds that I worked with for, after Goldman Sachs, was thinking about kind of the return on your money and the risk of the capital, right? So working for credit hedge funds, they worry first about the return of your capital and then the return on your capital, right? So kind of different than equity investors. And I have that is a great learning for me in working with credit hedge funds, in that I think about everything in that way. And I think about, when we think about our client portfolios, well, how does crypto play into that? And what I've been saying to friends and family, and now implementing at Centerfin, is a small allocation to crypto, preferably today diversified, but it could also be just Bitcoin and Ethereum. But small enough, I mean 1%, 2% small, where if it goes to zero, or if it goes down 90%, which it's done a bunch of times, or 70 or 80%, which it's done a bunch of times, it's not going to kill you. I'm pained, and one of the other reasons I'm glad we're doing what we're doing, when I read these headlines from the Wall Street Journal where somebody put all of their life savings in some crypto DeFi thing and lost it all.
Celsius account, right? Celsius, right? And
Celsius is one. I mean, there's been Terra Luna is another one. I mean, there's been a ton, and it really bothers me that people do not have somebody there for them to help them think through that decision, because that's just a bad decision. And so my point is that while I'm very cautious in the near term, I also do not want to not have exposure to certain things that I think have promise, but you have to size them accordingly and you have to adjust along the way, which is why, again, we've seen a lot of like automated, algorithmic investment programs and whatnot. We do not think in this environment that's the right approach because the world is moving really quickly. Things are very unpredictable. There are scenarios that we've not seen before. Algorithms, they depend on history. So they look, they use history of prices to predict the future. That's probably not a good approach in this environment.
Yeah, fantastic. So crypto, you mean crypto as to take it in your hard, how call it, hot wallet, or how do you call it? Cold wallet,
Cold wallet,
to take
yeah.
it, cold wallet, not to be to have it on exchange, right? This is a better idea.
Yeah, I mean, just generally speaking, again, not investment advice, but if you're going to own the actual crypto itself, you should own it in your own, you should have your own private keys on a cold wallet. I was actually just talking to a former Goldman colleague yesterday who visited my office, and I was telling him that, the beauty, the one thing I will say about Bitcoin, and this is not crypto in general, but Bitcoin specifically, and this is me, I come from the former Soviet Union. And so I have a very deep appreciation for something like this, which is
me too, by the way.
Exactly. Yeah, I figured. But there's no way that somebody can, if you own your Bitcoin in a cold wallet, there's no way somebody can take that away from you. It's uncensorable. What we experienced, and this is again specific to Bitcoin, not to get off topic, but what we experienced recently in Canada, if you remember, there were these truckers that were protesting the COVID policies in Canada, and the government responded by basically telling the banks that anybody that made a deposit, that made a donation to these truckers, because it was basically supported by people's donations. So people that didn't want to get out there and protest, they donated money in order to kind of express their protest, to freeze their assets, to freeze their checking accounts.
Just like Soviet style behavior.
Exactly. And exactly. And so when I saw that, it was very scary for me. And again, I was a kid. I was 9 years old when we moved here in the late 80s. But I remember this. I've talked to my father about it. It's scary, right? So the beauty of Bitcoin, and it could still fail, and there could be some other thing that replaces it. But for 13 years, it's worked, and it hasn't been hacked, and it continues to go despite the price. And I think that's the beauty of Bitcoin, is if you own Bitcoin, it has the greatest community of people working on it, and it continues to work through ups and downs and different market environments. And if you own it in a cold wallet, nobody can take it from you. So that's a very unique proposition of this asset.
Yeah, I know that there are another risk. For example, if you forgot your keys, you will never recover it. Also, there are some difficult technical issues for average guy that I'm not sure. Maybe these cold wallets are good for 1% of people who are in this online world or whatever, but the rest will not catch it. Maybe unless there is a better solution comes that will handle this, but still then it will somebody will have it for you. So it's still another risk. There is no risk-free solution.
I totally agree with you. I actually couldn't agree with you more. I think that we have not solved yet in the crypto space the user experience, user interface issues. And I don't know what the solution is. I know, there's very, very smart people working on all sorts of different angles, but I agree with you. And you're a risk person, so you understand this stuff. Like there's risk to having it in the cold wallet also, right? Like you said, like if you lose your private keys, you lost your Bitcoin. There's tons of stories about that from the early days of Bitcoin. But I do know I'm fairly involved in the crypto community, so I do know people are working on solutions. And I think, I liken, which is why I say, if you're going to have exposure, make it small. I liken Bitcoin and the crypto markets in general to what the internet was in the 90s, where it was still, people were still figuring it out. If you recall the early days of the internet, and I'm sure you were very involved given what you do. it was very hard to use. You know, it wasn't as intuitive as it is today. It wasn't as easy as it is today. And today it's easy and it comes naturally. My kids who are, 9 and 7, they use this stuff better than I do. And it's very intuitive.
All right. Thank you, Kyrill. We have had a really interesting interview, I think. So maybe we can take another one specific topic with you in a few months to discuss another maybe specific topic, like you said, distressed risk, distressed assets. We never talk about this on our platform. It's good to hear about this from the specialist. So for today, I think thank you very much, and I hope to hear from you in the future.
Thank you, Boris. Really nice talking to you, and thank you so much for having me on.
Absolutely.